Welcome back to another episode of Sunday School with your boy Buck Bandit P, man. You already know, man. Thank you for being here, man. You already know what this channel and this page is about. You already know what we do here. But for the new people who don't know what we do, for one, thanks for coming. Thanks for being here. We appreciate you. And all we do here is break down investing for average, everyday people so we could go out here and get this money. You understand what I'm saying? But listen, there's no shortcuts, no excuses, only progress. That's what we're doing over here. So if you're looking for a quick flip, you're looking to figure out how to, I gotta get this money real fast, this ain't that. Turn this off, go to something else. This ain't that. We're building real long-term wealth, something that we could pass down to our kids. Like generational wealth around here is not just a buzz term. Like we really putting in the work. So thank you for being here. Now, with that being said and out of the way, you already know, if you want your free stock, your free share of Robinhood, man, make sure you click the link down below and tap in so you can go out here and get this money with us and get off the sidelines and actually tap in when we, giving y'all this information. You can actually put the money where your mouth is, you hear me? And you already know, speaking of money, if you want a free $100, click the link down below, tap in with Allah, get your high yield savings account, man. You already know that's what I do, man. I got to get the high yield savings, man. I got to get the most bang for my buck as I can get. So let's get right into it, man. Last week, you already know, we did the episode on the market cycles, man. Some people was confused on the market cycles. So now let's dig deeper into what part of the cycle are we in? Let's get right into it, man. What part of the cycle are we in? The current market cycle. Let's see. Right now, we are in what we call the late expansion early slowdown phase. So all that means is, you know what expansion is things are getting bigger. We're in the late phase of that, meaning things ain't getting no much bigger right now, all right? And early slowdown, meaning what's a slowdown? Things is coming, it's coming to a stop, you know what I mean? Or it's not coming to a stop, but it's not going as fast as it was going. So we in the early stages of that, late expansion, early slowdown. The economy is still growing, but several indicators are deteriorating. Let's get into it. Part one, the evidence. What investors actually watch. Number one, economic growth is slowing, but not collapsing. Early cycle growth is explosive. Late cycle growth looks like GDP still positive, consumer spending slowing, corporate growth is moderate, and economists, they usually measure this by inflation. So they expect inflation to be around 2% growth. However, they expect the economy to grow around 2%. However, the economy is not growing right now. Like they expect the economy to grow faster than 2%, and it's only growing about 2% right now. So what does that mean? That just means that the boom already happened, man. We already went over the AI boom and how big money is moving their money out of the AI boom, and they're trying to position themselves and to get a more return, better bang for their buck. So, like I said, economists expect roughly 2% growth, but the economy is on autopilot right now. It's not accelerating. So all of that mean is we're not growing at a fast rate like they would like to see us grow. So it's stalling. Also, part two of this, the labor market is strong, but it is weakening. So what does that mean? The unemployment rate is about 4.4%, which is historically healthy. Like that's pretty good. However, the direction matters more than the numbers. So what does that mean? It means that what we're seeing is job losses in some reports, but we see slower hiring. Like they letting a lot of people go, but they not quick to hire people. We also see rising unemployment rate from the cycle lows. So also, that's exactly what happens in the late cycle right before recessions. People start losing their jobs not really looking to hire nobody. You see what I'm saying? So it all plays into a part of the phase that we're in right now. So like I said, that's exactly what happens late in the cycle right before recessions appear. And also what makes this a big deal. Why this is a major piece of the pie is because add on inflation right now is sticky. Central banks want inflation around 2%. However, the reality, inflation right now is around 2.83% globally. So we still trying to get inflation down. And then the energy shocks are pushing everything higher. Like, we see what's going on. I'm gonna get into that. And also, the Iran is a reason, because when the oil going up, that's making the energy go up, and that's pushing the inflation up, and that's making the stocks go down. So it's all plays a part. And then also, we have to understand that the late cycle economies get hit by energy spikes right before the downturn. Like, this is what they mean when they say history don't always repeat itself, but it rhymes. Because in order for certain things have to happen, certain levers have to get hit. And then it's just historically, you're going to see what comes, because you see what happened when there's high inflation. And then we got a war going on. And then we got bond yields. I'm going to get into that. And then we losing jobs and companies not hiring. All of that ties into why we are in late expansion and early slowdown mode. Also, let's get into the Fed. This is the favorite part everybody loves. Interest rates are still restrictive. So what does that mean? The Fed is not rushing to cut the interest rates because inflation is still high. So rates remain around 3.5 to 3.7%. with uncertainties about when will the Fed begin to cut these rates. So the late cycle, why we can say this is a late cycle, because the late cycle pattern tells us that rates rise, economy slows, the Fed hesitates to cut rates, and then something breaks. And God forbid something break. If something break with the war, anything, I mean, if God forbid a bomb go off on American soil, that's going to be something break, and that will push us into a recession very fast. But the thing is, we hope that the Fed will cut rates before that happens so we can avoid that, so it could be quote unquote a soft landing, and we'll get into what that is. So right now we're somewhere in between 2 and 3. 2 and 3 is the economy slows and the Fed hesitates. 4, something breaks. 5, then rate cuts. We between 2 and 3. The economy is slowing and the Fed is hesitating and they not cutting rates. So the real macro picture, like what big money is thinking, serious investors are debating 2 outcomes: a soft landing and a late cycle break. Let's get into it. A soft landing, that's when growth slows, but we avoid recession. The Fed cut rates gradually, the economy stabilizes, and the markets you start seeing green in that portfolio again. That's scenario number 1. That's a soft landing. Scenario number 2 is a late cycle break. That's something like credit markets, real estate, regional banks, corporate debt, all of that. Margins start getting caught, all of that is start going crazy. You see the credit, people defaulting on their credit cards. You see people losing their houses. You see banks getting bailed out. You see corporate margins getting caught and they got to pay all the money that they owe. Like, that's when the cycle resets. That is the hard reset. That's the recession. That's everybody lost their job. People getting evicted, cars getting repossessed. That is a possibility if it's a hard landing. So the wild card right now is oil. Everybody know wild card is oil because the Strait of Hormuz and all of that. If you checked out the Financial Friday, you already know, we already went over it. But this is a real thing because energy shocks historically end expansions. Historically, anytime energies start shooting up, start climbing crazy, that's usually a sign the expansion is over. So at the time of this recording, oil is around $100 a barrel because it's no peace in the Middle East. Yeah. Remember the saying back in the day, man, I just want peace in the Middle East. Right now, ain't no peace in the Middle East. Oil like hovering around $100 a barrel. They saying it could go up to 150. Listen, man, it's getting crazy out there. So this is exactly what kills the late cycle expansion. So we have to understand with the rise in inflation, the consumers, us, we gonna get hurt at the gas pump, and then the economy gonna slow down. And then that is when professional investors like us here, that's when we take advantage, because a lot of opportunities is out there during this time. And we don't want to profit off of people demise, but if we still here, we got to make sure we in position. We can't just be crying in a corner because it ain't no peace in the Middle East. It is what it is. It probably will never be peace in the Middle East, but we still got to position our portfolios properly. Ew, I like that. That might be a new saying. Position your portfolio properly. Ew, I like that. That's a new one right there. But yeah, so you got to think like a professional investor. And if you're thinking like a professional investor, a late cycle strategy is usually reduce your risk, increase your quality of your companies, and hold some liquidity. And all that means is have your dry powder, have your buying power, have money on the sideline. So if anything comes up, you don't got to cash out your investments too early. You can still jump on something if it's at a super oversold price and you know that this company is way worth more than what it's priced at. You can still have some dry powder, some little money on the sideline to put into that. And if you never know, you might lose your job. You still got dry powder, you still got money on the sideline, so you can still handle your business and still don't got to cash out your investments, because you always want to keep your investments in place, because you always want to take advantage of compound interest. You want that compound interest to work. That was the very first episode I dropped. Make sure y'all check that out. You want the compound interest to work, so you don't want to cash out your investments every time you lose a job or Trump get in office or some crazy shit. So we not panicking. The key thing is we not panicking. We not YOLO into everything and, oh, we see this, now we putting in options and all that. Yo, this is not the time to put in options if you ain't ready for a haircut. You understand what I'm saying? Because there's no telling what the market is going to do overnight, pre-market, because the geopolitical tension adds in too many variables to the already crazy stock market. All right? So the simple truth, we are not in a recession yet, all right? So we good. We not good, but we not in a recession yet, all right? We are not in early expansion neither. We are sitting in the uncomfortable middle of a recession in the early expansion. So what that means is growth is slowing, inflation is stubborn, rates are still high, the Fed don't want to cut them, geopolitical tensions are here, Trump talking about putting boots on the ground in Iran, that's going to hurt our portfolios even more. I'll get into it, you know what I mean? And in other words, smart investors know this is the time you play defense. You keep your buying power heavy, you buy quality, and you don't go heavy on options, and you always diversify. All right, so the closing thought, man. This is the time when smart investors buy good companies on sale and end up looking like geniuses when the smoke clears. Say that again. This is when smart investors buy good quality companies on sale and end up looking like geniuses when the smoke clears, man. This is how people become internet gurus, because they just understand you buy quality, hold it through all the turmoil and the headlines and the tension, and you're going to look real smart in a couple years when all of it's over. So thank y'all for being here, man. That is another episode of Sunday School, man. You already know what it is, man. I appreciate y'all. If you found this information helpful, if you liked it, if you could vibe with it, if you could feel what I'm saying and it helped you out, make sure you share it with somebody, man, so you can help them out, man, so they can understand the market and understand that this shit ain't as scary as they be trying to make it sound. They just got on suits and they use big words and they on MSNBC, so it seems scary. Tell them to tap in with us so we can go out here and get this money.